Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden financial stories that shape our world today. We are diving deep into the freshly filed S-1 registration statement from Praetorian Accession Corp, a blank check company looking to make its mark on the stock market. We will dissect their financial roadmap, their ambitious plans, and the journey they are on to becoming a publicly traded entity. If you appreciate getting straight insights from corporate documents, make sure you're subscribed and join our Discord community linked in the description below. So Praetorian Accession Corp is essentially a business looking for a business to buy a blank check company, if you will. They aim to merge with a company and take it public through this process. They have about $220 million set aside for this grand acquisition. Right now, they haven't picked a company to merge with, so the options are wide open. They are thinking about targeting businesses that can use automation and artificial intelligence to improve. But honestly, they could go after any kind of business. This offering is about getting funds so they can find that perfect match. For those units at $10 each, you get one share and a third of a warrant. That warrant lets you buy more shares later if things go well. They are planning to list on the Nasdaq under the ticker TORO. Now here is where things get interesting. Their sponsor, Praetorian Sponsor LLC, is buying a good chunk of warrants on the side. These are like bonus warrants that the sponsor can buy if the over-allotment option is fully used. They are paying $1 each for these, and these warrants will be identical to the public ones. The founder shares. These were bought by the sponsor for practically nothing at about $0.003 per share. This is a really common SPAC strategy. They get a big stake early on for a tiny investment. This could mean a huge profit for them later, but also means our public shareholders could see a lot of dilution. They have a pretty tight timeline, 24 months or sometimes 27 months to find a company and combine with it. If they don't, well, it's back to square one and the money in the trust account goes back to shareholders. Let's check out the actual financial snapshot right now. As of the 24th of October 2025, their balance sheet shows a very early stage company. They have just $25,000 in prepaid expenses and $32,317 in deferred offering costs. Total assets are a mere $57,317 with liabilities of about $50,141. This leaves them with a tiny shareholder equity of just $7,176. It's basically a shell company getting ready for business. The as adjusted column is where the real picture emerges after the offering. Total assets skyrocket to over $222 million, mainly from the cash they are about to raise and hold in trust. Their statement of operations is super short because, well, they just started. They have a net loss of $17,824, which is basically just operational setup costs. No revenue yet, of course. Now for the risk factors, and boy are there a lot. They warn us about the difficulty of finding a business, the possibility of losing money if the deal falls through, and the inherent risks of any business they might acquire. They also flag that their initial shareholders who bought shares for pennies could make a fortune even if the stock price tanks after the merger. That is a classic SPAC risk. And your main path to getting your money back if things go south is through redemption. They are basically saying you might only get to vote with your wallet by cashing out. They are very upfront about the dilution from those cheap founder shares. They calculate that if things go as planned, the initial value per public share is $10, but after the merger it could drop to around $7.23. This means the sponsor could still make a killing even if the stock price falls. It is a calculated risk for them and a potential downside for us. Hoping to get listed on Nasdaq under TORO is their next major step. If they don't get listed, that could be a big problem for trading these securities. Finally, the underwriting section. Clear Street LLC is the sole bookrunner. They are getting a piece of the action with underwriting discounts and commissions. And there are those deferred underwriting commissions that will be paid out only if a business combination happens. Plus, those representative shares given to the underwriters are also a significant part of their compensation package and are subject to lock-up periods. Now zooming out and looking at this filing with a Warren Buffett lens, Praetorian Accession Corp fits the typical blank check company mold. They have a seasoned management team with SPAC experience, which is good. Their strategy is broad and opportunistic, which can be a strength if they find the right target, but also a weakness leading to unfocused pursuits. The biggest narrative here is the inherent conflict between the sponsor's early low-cost investment and the public shareholders' higher entry price and dilution risk. The founder shares and warrants held by the sponsor create a powerful incentive to get a deal done, even if it's not the absolute best for public shareholders. The SPAC market has also seen some turbulent times with many companies struggling post-merger, so the success of Praetorian's venture is far from guaranteed. The risks are heavily weighted towards the ability to find and close a deal within their timeframe and the potential for significant dilution. So what is my take after decoding this S-1 filing? Praetorian Accession Corp is setting the stage for a potential merger by raising capital. The leadership team has experience, but the structure itself introduces significant inherent conflicts of interest. The potential for dilution is high, and the primary success hinges on their ability to execute a favorable business combination within the strict 24-month window. It's a high-risk, high-reward scenario typical of SPACs, and investors need to be acutely aware of the sponsor's aligned, yet potentially misaligned incentives. The real test will be the target they eventually find, and how well that target integrates and performs post-merger. Alright, that is our deep dive into Praetorian Acquisition Corp S-1 filing. What do you think about their strategy and those founder shares? Drop your insights in the comments below. If you found this analysis valuable, hitting that like button really helps us out, and subscribe for more Decode corporate filings. Don't forget to join our Discord community for more discussions. Thanks for watching, see you next time.